guys, thanks for requesting the information here on the first-time homebuyer video as far as what mortgage programs are out there, what ways in which you can buy your first-time home. We're going to go over some of the government programs, some of the conventional programs, but just more importantly what we see on a daily basis with regard to folks that are in that situation. We're going to talk about some of the frequently asked questions that we hear, some of the specific steps that it takes, and go from there. So let's jump into it.
Okay. Well, Jason, why don't you start off by telling us what some of the more popular options are for a first-time home buyer. Sure. Give us some specific programs that they might look for.
Well, there's a couple of them. Most of them are government-related. There is the FHA loan, which is a Federal Housing Administration. We'll talk about some of the particulars, but the FHA loan is one in which most people hear about when they're thinking first-time home buyer. We actually have a lot of folks who think FHA stands for first-time home buyer. But that being said, first-time home buyer program is currently 3.5% down. Geographically, can use it anywhere. A lot of folks use it. You can have a gift of your down payment. Another program that we hear a lot of, first-time home buyer or not, is a VA loan. The VA loans are a zero-down loan program, so that's a fantastic one. There's also what's called the USDA Rural Development Loan. That's also a zero-down loan program. That one is eligible to anybody within particular restrictions for geographics as well as incomes. But that being said, those are three. I'll say that's probably most common what we hear are those three, so FHA, VA, USDA Rural Development. Conventional, not as much over the years because it's 5% down, plus it's pretty heavy as far as some of the mortgage insurances and such. But do you want to start digging into the FHA loan and talk a little bit about that?
Well, sure. Well, it certainly seems like the government's at the helm of the boat when it comes to first-time buyers these days, and that hasn't always been the case, but FHA is really a nice product for people. Again, Jason mentioned it's a 3.5% down product, but that does not have to be your own money. All of that money can come to you by way of a gift, and that's really desirable for kids just starting out. We all know how hard it is to get your feet under you when you're first on your own. So that's a really nice feature.
And that's one point too. I mean, really the FHA loan specifically can be used by anybody. Often in today's environment, we see people buying the third, fourth home in their lifetime via an FHA loan, only due to the fact that with some of the 4 or 5 years ago with the equity depreciations and such, people don't have as much money as they have in the past. So regardless of your 21 or 61, FHA programs are fantastic.
That's right. Again, I mean, they only care that you're going to occupy this property.
Correct.
That's really their only rule. So as Jason said, you don't have to be the first time, but you do have to plan to live there. So this is not a product that an investor would use to purchase a home, for sure. That being said, you can certainly purchase a multifamily home as an FHA and have some investment built in. So that's another way that you can help to offset some of your expense of the mortgage.
How about some of the comparisons between this and the conventional loan as far as like the mortgage insurances and such?
Sure. Well, obviously the down payment is different between this and conventional. The mortgage insurance is different in that you pay something called a MIP, which is a mortgage insurance premium. But the good news is that mortgage insurance premium can be financed. So you put that on top of your loan, and you're not paying that as part of your monthly fee. So.
And it's not coming out of your pocket.
Exactly.
But then there is a part that comes out on a monthly fee.
There sure is, and the government also has to make sure that in the unfortunate cases of default, they have a pool to draw from to cover those. So there is a monthly mortgage insurance that you would pay as well. The other thing that's interesting to know with FHA, and this is what's making it one of the most desirable options right now, is you can go down as low as 640 with your credit score without having significant impact on your interest rate.
Sure.
And the conventional side, if you had a 640 credit score, you're going to have a pretty good hit to the interest rate. So FHA is going to give you some leniency there, and in some cases at AndyMac, we can even go down as low as 580 with certain criteria, but that's obviously the exception.
And as long as there's mitigating circumstances on the positive side, that'll help that out, And that is a key point. So again, just to reiterate, FHA, there's a monthly mortgage insurance fee, and then there's an annual, just one-time fee that is financed in, and then there's a monthly fee. And just comparatively, to give you a comparison between this and a conventional loan, the monthly mortgage insurance fee on an FHA loan is about 2/3 of what it is on a conventional loan. So it's a good deal cheaper as well when you compare this to a conventional loan. So how about to compare rural development, VA? Let's just talk about, since we're on it, what are the comparisons between these three types of loans together?
Sure. Well, rural development and VA are your two no money down options. Rural development is really a product that I favor for first-time buyers. I work in many areas that are outside of the major metropolitan areas. Not that there is such a thing in New Hampshire for us, but what we consider a major metropolitan area. But certainly places like Londonderry, Manchester, Concord are not going to have availability for this product, but any of the outlying areas, It's a great opportunity because the mortgage insurance, talk about affordable, is about a third of what it is on a conventional mortgage. And so true no money down, very minimal mortgage insurance, very attractive interest rates.
Sure.
VA, same situation, no money down, no mortgage insurance, just a funding fee that they pay. So almost across the board, the products are similar in terms of their credit requirements, in terms of down payment going from 0 to 3.5%, and very light mortgage insurance compared to a conventional loan.
Sure. So even if you want to rank them, and real quick, mortgage insurance basically is for folks who have less than 20% down on properties, and ultimately what it does is it's basically ensuring that, God forbid, if something does happen and the home does go into foreclosure, but the lender doesn't lose their shirt on that property as well. So it's just a key point when you have less than 20% down. We talked about years past where if you didn't have 20% down, you couldn't buy a home to begin with. So those are the days of old. But when you compare these types of loans, FHA, VA, and USDA or rural development, USDA rural development is one program. When you compare these three programs, if you are a vet, they all, basically all of these programs themselves have funding fees, which are upfront fees. All of them can be financed in, but then on the monthly insurance fee, when you compare them, USDA is the lowest, well, technically VA is the lowest because there isn't one. So VA is the lowest, USDA is the second lowest, FHA is the highest of the three, or the third lowest, all when you compare to conventional. So just a key point right there, so it's just something to be important of. How about, let's dial into the houses as far as what type of properties can you buy, again, just across the board with those three types of programs.
Sure. Well, all three will allow you to buy single-family homes, multifamily homes.
Sure.
Condominiums is really where it gets tricky because all of them maintain a list or refer to somebody else's list when you're buying them. So it's important that you really hook up with a mortgage professional or a real estate professional who can guide you to the appropriate properties, because what we don't want to have happen is that you're in the right price point, you found a property, it meets all your requirements, and lo and behold, for one reason or another, it doesn't meet the requirements to be approved. And
how many people have told us that, where they do it a little bit in the wrong scenarios, and they'll go and they'll get the home under contract, they'll fall in love with it, they already mentally know where they're going to put all their furniture, and then they come to find out that it's not approved via the condo complex itself isn't approved. So
now I know with my first-time buyers, one of the first steps I take if they're looking for a condo is to review those lists and let them know which properties are eligible, and if they do find a property that's not on the list, we can certainly get those approvals going quickly, even if it's just a property of interest, they're not making an offer, just so we have them prepared just in case.
And that's a key point too, because not everybody can do that. So that just has to do with the strength and the size and stability of our company, but you do have that ability where if they're not on the list, we can get them on the list if they're eligible to be on the list. And a lot of what they look at in that respect, we won't dial too deep into it, but just really financial stability and such is a key factor. Level of delinquencies with regard to the condo complex and the other homeowners and such, because that is the one situation where, for example, if it's a single-family home, your neighbor doesn't directly affect you to a great degree. With the condo complex, they really do, because they're all throwing money into the kitty every month for when you need repairs and those sort of things. If they live there, if they don't live there, that also affects you as far as an investor versus not. So just a key point when you're looking at the properties. But
sure, and I think all the things we look at on that condo questionnaire really are for the borrower's benefit. Maybe you want to live in an association where you know there's a strong reserve pool, so if there is a calamity, it can be taken care of,
or even
and you don't have an assessment.
Sure, even just repainting and upkeep and stuff like that.
Sure, the standard stuff it's there for.
Yeah. How about one thing as well, as far as who can get the particular types of loans? On just a quick broad brush, VA is easy. You need to be, obviously, you need to have some sort of relation with the military. Yeah,
at some point you had to have either been an active duty, a reservist, or the spouse of one. So.
And we also have some other videos if you have particular questions with that as well. So how about RD and FHA though? Who can do it?
RD and FHA. FHA doesn't require you to be a first-time home buyer. Again, they only require that you occupy the property, so that's really eligible to anyone. Providing you meet the credit matrix otherwise, of course. And USDA, geez, Jason, I'm not sure, do they still want us to be a first-time buyer?
No, you can do anything as well. The biggest thing you run into with the, and again, we interchangeably say USDA or RD, but with a rural development loan, the biggest point there is, again, there's geographic restrictions as far as where you can buy. As Andrew was saying, some of the major metropolitan areas, and not necessarily even major, but some of the larger areas as far as population and such are the ones in which they're not rural, so you can't buy whereas if you're, whereas it's not as set and defined as one would think. But that being said, we can, again, steer you through that. There are maps and resources that we have where we'll take an address and find if it's eligible or not. But it's not as easy to think. Some folks might think one area would be where another one wouldn't be, and it's a little backwards in some ways. But and then there's income restrictions. You want to be careful about that. You can't make too much money per se. But you also can't make too little money because we take a look at your debt ratio as well to make sure you're not over-encumbered via debt. But
so almost by definition, it's kind of geared from an income point of view towards a first-time borrower.
Correct.
But there's not a requirement for it to be a first-time
or a moderate income borrower, maybe is a good way to say it.
Mm-hmm.
How about the steps? What are the actual steps that are needed? Again, regardless if it's FHA, VA, rural development, what are the steps that somebody would do to starting fresh to ultimately getting to the closing table? What would somebody go through?
Okay, well, we would always encourage you to get pre-approved, and that's different from being pre-qualified. We're actually going to gather all of your documentation to make sure that you can get approved for this loan, even prior to you finding a property.
Sure.
And most real estate agents these days, you know, Jason, as well as I do, they're going to require you to have that piece of paper saying you're pre-approved in order to even present an offer.
Right.
But from a consumer's point of view, and for certainly a first-time buyer's point of view, you really want to take this thing one step at a time. The process of buying a home can be overwhelming. And so we want it to be a pleasant experience. We don't want you to feel so buried in paperwork and details that you can't really enjoy the process of buying your first home.
And it's so key why you have to be really, really, really want to take a good look at who's around you and who's part of your team, because that's such a key point.
And it really is a team now more than ever that the consumer is linking themselves not just to a real estate agent, but also with a lender, and allowing the people to communicate freely with each other, so that we can make sure that we're getting it into the right product, and that anything that needs to be on the purchase and sale can be addressed with a real estate agent to be sure that you don't accidentally end up with a surprise at closing of cash you weren't planning on.
Completely.
So that's always the first step, no matter what program you're going through. Veterans have a little different requirement. They have to get a certificate of eligibility, but otherwise the next step is we get all of the income, asset, and credit information together. Typically, it's going to vary depending on whether you're a W-2 employee or a salaried employee, or it's self-employed. And we actually have a video, or a mini video, of and a list that we can provide you of documentation that's needed and the specific circumstances that it's needed in. Because we would bore you to tears if we sat here and told you you need this sometimes and here's the sometimes.
And things change on a daily basis.
For sure. If we know nothing else, we know that our industry is changing day to day. So we're going to gather all that information up. We're going to appraise your property. At the same time, you might be doing inspections depending on the particular program. You may have to do a water test, septic test, pest test. Once all that information is gathered together, it's reviewed by an underwriter who's going to make sure that the documentation we have meets all the specific program guidelines. So that's when the good news comes in. Jason gets the phone call that the borrower has been approved. So tell him what happens after that, Jason.
Yeah, ultimately what we're always trying to push towards is what's called a cleared to close. And what that means is, again, when we run your initially for approval, we get a list of the documentation that we need to have given to us to make sure that we can ultimately get you the loan. And like Andrew was saying, bank statements, asset documentations, income forms, things like that. Once we get that, processing has it, they make sure that what we have is exactly within the other list. They cross them off, make sure there's nothing funky or out of the ordinary. And if there is, and truthfully there's always something that comes up, they then request what's required, take that, match it up, submit it to underwriting. Underwriting blesses it. And then it's basically what we call clear to close. And the clear to close is, again, the great point, because that's where the numbers are put together, and you're ready to roll and set your closing date. I can tell you one thing that we spoke about, and this just had to do with the scenario that we had last week, but it's so key to make sure that this is taken care of in advance before you put an offer on the table as well. A perfect example is due to assets and such, especially with first-time home buyers. We have folks that, using FirstTime in particular, who may not have a great deal of assets that are to their name, let alone if they do, maybe they're just retirement dollars and they don't want to have to pull from there. So one of the key things you want to make certain is when you're putting your offer together that in the process while we're doing the approval, maybe you're going to add in what's called seller paid closing costs or lender paid closing costs. And what that's going to do ultimately is reduce the amount of money that you need to bring to the table at the actual closing table. A scenario that we had last week was a first-time home buyer, husband, wife, living in a rental down in Nashua. Put $500 down on the home at the initial deposit. Ended up closing the loan and actually getting $251 back at closing because the seller and the lender, we paid ultimately all of the closing costs, but $249 is what it ended up being. So they were very happy. They literally got a check at closing for part of their deposit, which was significantly motivating for them. Plus, it's such a great feeling to not have that angst of,
Well, and I think there's such a misconception out there that the no money down programs are gone, that you need to have a big down payment, and that is absolutely not true.
Well, and some lenders will be telling us, not everybody has access to the same types of programs that are out there. So for some folks that is completely true, and they're not steering you wrong, but it just comes down to making certain that you're talking to a lender who has the programs at their disposal that you're going to have find of importance to you. And again, that's just a key point of who you're talking to. So.
Well, and Jason, while we're talking with first-time home buyers, I think it's important for us to point out some of the things that they don't want to do.
Yeah.
Always before we close on the loan, we're going to verify employment. So this is not the time to make a job change.
Don't get fired.
Yeah, don't get fired now, and don't even be proactive looking, because we're going to make that phone call finding out that it's likely that you're going to continue to stay there. The other thing that we have to do these days is pull your credit report again prior to closing.
Extremely important.
Especially with first-time buyers, since you may not have a real deep credit history, your score is more susceptible to change than anyone's. So even though you may not have done something that resulted in a derogatory information on your report,
like missing a payment or anything like that.
Simply going and making a new purchase or getting a new credit card could be detrimental and can ultimately cause you to go from a proved happy homeowner to having to wait for your score to recover. So definitely talk to your mortgage consultant before you do anything involving money. And if you're considering even moving money from account to account, all of those things can create more workforce, and especially if they happen at the 11th hour. So once we start these wheels in motion, you almost want to freeze frame your financial picture as much as you can.
Correct. It's such a good point. I can think of a family seven some odd years ago that ended up buying a new truck in the middle of the process. Truck was $500 and some odd was their monthly payment. Well, that $500 and some odd, and to even make things worse, the car that they got rid of was owned outright. So they had no payment to a $500 and some odd payment, and ended up moving them from an approval to a denial. Unfortunately, they actually had their home under contract already as well, so it was not a happy day. But that is such a key point. Even going from leasing your car that may now the lease may be ending and a new one coming. Or again, even in those more extreme, you may have just a couple payments left on one, and then you decide to sell it and get something new. That can 180-degree change into your status. So great point of the freeze frame. You really need to do that. It's just a key thing to keep in mind.
Well, I know myself, when I turned in a lease vehicle, I had made perfect payments on it. It was just time. The lease was up. I turned it in, got a new one. And the credit score after that for the next 3 months was 40 points lower. And I was a good credit risk. So
well, because now it's a brand new one good credit goes away, and now a brand new one only has 3 months history.
And we just know from having done this for so long that once you're in this mode of we have the new house, there's things we need. Please don't do it until you're moved in.
Well, even throwing the $1,200 fridge on the
absolutely on the credit card
as well, or getting that new Home Depot card. Just be careful of that as well.
Just talk to us. That's all we ask.
And that's the key point. Just take from this whole video. Any questions you have, be comfortable with your team. Have security in knowing that they know what they're talking about. Again, right here we have just about 40 years worth of experience between ourselves. So you just want to make certain that that's a factor that you're keeping in mind. But any questions, anything, please just reach out to us with the information following this video, and we'll be sure to step you through the process and get yourself on the way to getting into a new home. So again, thanks for requesting the video, and we appreciate you coming by.
Looking forward to helping you make the American dream come true.
Perfect. Thank you.